The last time we heard from the Fed in an official capacity was back in January, with the central bank issuing its final decision with Janet Yellen at the helm. Since then, the world has changed a bit, and the changes we've seen have the Fed feeling better about its forward guidance and the market taking the Fed's forward guidance more seriously. Interestingly, in a bit of a twist, the January monetary policy statement anticipated the changes we've seen since, with hawkish tweaks to the language referencing further rate hikes and a confidence that inflation would pick up in 2018. Sure enough, the monthly employment report produced a healthy jump in average hourly earnings, which was then followed up by this latest jump in the CPI print. So while we're not sure the minutes will be wanting to rock the boat too much today, there's plenty of evidence that would suggest the minutes will continue to walk in this more hawkish-leaning path. How the Fed decides to talk about the impact of the latest round of tax cuts and whether or not there is any indication of more members considering the possibility of not 3 but 4 hikes this year will be some of those things the market will be looking for. The dollar has already been trying to make a comeback as it has taken all of this in over the past few weeks, but there has been a reluctance to want to move too much, with an understandably skeptical market most probably looking for a little more confirmation before ramping up any dollar bids. Of course, a lot of this tentativeness also has to do with the main thorn at the side of the dollar over the past year, which has been a soft dollar policy campaign from the U.S. administration. But overall, as we consider recent developments, there doesn't seem to be much reason to expect a message that is less hawkish than the one we got in January, when there was less substance at that time to back up what ended up being a surprisingly hawkish-leaning decision. Now, this could very well be a baseline case, which means a real possibility there isn't much more than a short-lived reaction before the market looks to find a trigger for volatility from somewhere else. As a final note, Fed Powell is going to be getting real busy as February winds down, with the new central bank governor offering up interest rate outlook testimony to Congress. With that in mind, we do wonder if the minutes pack any surprises to lay down the foundation of what is to be expected in the Powell regime. Anything the market perceives as leaning more hawkish today will likely fuel more dollar buying and concurrent downside pressure in the stock market, while anything that fails to live up to the January message will likely invite renewed dollar selling and another push higher in stocks. That's all for now.